Happy Friday out there, Team 42. It's your skipper here, Darius to present our macro minute for Friday, October 4th, 2024. It's Friday jobs report day, so you know what? It's also Friday macro scouting report day, and this is probably going to be our best macro scouting report ever. We've done one of these every month since we launched the firm in early 2021, so I'm super pumped about this presentation, and it's going to be live in our client inboxes this afternoon. So, but before we get into that, let's just get into the executive summary from today's leadoff morning note. Today's key, as always, if you would like to review the analysis supporting these conclusions, as well as what specific changes you need to make in your portfolio to remain on the right side of market risk, you need to be a client of 42 Macro. So today's key macro question is, what is the current state of the U.S. labor market? Our answers are: the September jobs report was supportive of our resilient U.S. economy theme and pushes back on hard landing fears still being positioned for by an impactful minority of investors. We anticipate their eventual capitulation will fuel a year-end performance chase as the SPY and other risk assets climb a wall of worry that itself will be well supported by geopolitical concerns and U.S. election consternation. The September jobs report will be the last clean jobs report before the general election on Tuesday, November 5th, and the next FOMC decision on Thursday, November 7th, due to the impact of Hurricane Helene. Please donate if you can. The key takeaway from today's report is the U.S. labor market is fine, which is what we've been arguing for via our resilient U.S. economy theme for over 2 years now, most recently at the prior bear trap lows of early August. Transitioning to our 42 macro dashboard, this is a question here. As always, we'll wrap up with a question from our client community. This one's regarding Bitcoin versus gold. So I read the question. It says, in KISS, it sounds like it's fine to substitute Bitcoin for gold or a portion thereof or some other commodities. If KISS signals to trim down Bitcoin like it did, what would be the pluses and minuses of moving out of Bitcoin into gold, silver, instead of going into USFR or the other commodities that are still long full positions in Dr. Mo? PS Gold's MACD is curling down from the top right now, so I think I'd want to wait to see how that plays out. But in general, how good or bad of an idea is this? Thanks much. That's a phenomenal question because it's not something I've given a tremendous amount of thought to in that context. So one of the things I do for our Pro clients is I help them customize versions of KISS for their clients or themselves. So we have high net worth investors as well as our Pro clients, and some of the back tests that we've constructed for them and strategies that we've constructed for them within the context of our systematic KISS portfolio construction process were designed to if the fixed income position, for instance, wasn't maxed out, should we allocate that to equities because that we're in a risk on market regime or something like that? And by and large, those strategies generally add incremental value to the performance of the process. Again, it's more risk, but again, it's more reward. Obviously, we've been in a raging bull market, so any out of sample back test over the past 5, 6, 7, 8 years is going to show some positive performance. But thinking about this in the context of the alternatives bucket, which is where we put the Bitcoin bucket in this 60-30-10 trend following strategy. In the context of that, those are generally speaking going to be higher beta plays. And most importantly, Bitcoin, specifically when you're heading into a market event, has proven itself to be a leading indicator, oftentimes a long leading indicator of corrections and or crashes in asset markets. And so, you go back to November of 2021, you go back to, I want to say January of 2020, you want to go back to even early 2017 prior to 2018, Bitcoin peaked, I want to say in 2013 prior to 16, Bitcoin has proven to peak out well in advance of significant corrections and crashes. So I don't know that the right strategy for this particular bucket is to say, okay, well, the market is the KISS has taken down exposure to the highest beta play, which generally speaking, the higher beta plays tend to break down before the lower beta plays because they are more reliant on liquidity and sort of general sentiment out there in the capital markets. And so I don't know if the smart strategy would be, okay, this thing's breaking down. It's normally a long leading indicator of the market breaking down. Let me actually get more allocated instead of raising cash. So my general gut feeling on this specific question is probably just to raise cash when KISS takes down its exposure to Bitcoin. But again, gold is a lower beta play. You're not going to lose your shirt investing in gold. And obviously what KISS does, and the best thing KISS does is to maximize upside capture in bull markets and minimize downside capture in bear markets. So even if you did rotate into something like gold, which is a lower beta expression essentially of the same thesis, then you're probably not going to, suffer a significant drawdown. So I guess I just talked myself into a complete full circle and saying that's probably a good idea, but probably only for gold specifically. So we'll wrap it up there. As always, actually, before we wrap it up, hopefully you learn from this discussion is that KISS is eminently customizable. Obviously, for those who may not know, KISS is a systematic 60-30-10 trend following process that is specifically designed to demonstrably outperform the 60-40 portfolio, which it has done on both an out-of-sample basis and a live basis. KISS has been running live since January of 2023. And sort of how it does that is it does it sort of through three lenses: factor selection, adding 10% Bitcoin, taking 10% from fixed income, which we're structurally bearish on, and put that 10% in the quote unquote alternatives bucket, which we find Bitcoin to be by far the best alternative asset out there. And then we use our top-down market regime nowcasting process to infuse our volatility targeting into the approach, and then we use our volatility adjustable minimum signal to infuse dynamic position sizing into the approach. And so there's a systematic trend following element to the process that allows it to dial up and dial down its exposure to each of those three ETFs, SPY, AG, and FBTC at any given time. And so, at some points KISS will be fully invested. At other points, KISS will be, near, 100% cash, if we're heading into a market crash. And so, and KISS, one of the things I'm most proud of is that KISS has proven itself to do a great job of getting clients back invested after market crashes, right? That's one of the things that investors struggle with most because, after a market crash, most people are ragingly bearish. The data is ragingly bearish. The policy is typically ragingly bearish. And so things like that, you typically don't, a lot of investors struggle with that. So, we're proud of KISS for helping clients with that. But generally speaking, what we're trying to do with KISS specifically is simplify investing for retail investors, help them drown out all the noise and the bear porn out there and just respond dispassionately to signals so that they can actually make money and participate in raging bull markets, and then also book gains and steps to the side when there's a bear market developing. That's it. That's all KISS is designed to do, and it does a fantastic job of that. It's with average annual return on out-of-sample backtesting basis of plus 15%, which compares to plus 9% for the 60-40 portfolio. 60-40 portfolio has a maximum drawdown of minus 22% throughout the life of our auto-sample back test, which begins in January of 2018. The KISS maximum drawdown is less than half of that at minus 12%, and it's the only double-digit drawdown in KISS throughout the entirety of that back test, whereas the 60-40 portfolio has crashed twice in that time horizon. So we're really proud of this. We're outperforming on the upside and outperforming from a volatility and risk perspective as well. If you look at a Kalmar ratio on KISS, is something like 1.3 versus I want to say like 0.4 for the 60-40 portfolio. And if you don't know what a Kalmar ratio is, that's the average annual return divided by the max drawdown. That's one of the most trusted statistics that institutional capital allocators look at when they're evaluating different managers and different strategies. So I'll wrap it up there. I know I went on a little bit long today, but super pumped because I'm got a little coffee in my system here, and we're pumped for our macro scouting report that's going to be in client inboxes this afternoon. So we'll catch you back here on Monday. Everyone have a wonderful weekend. Enjoy some football, and let's see if the Seahawks can respond to getting punched in the mouth on Monday night. Cheers.